Hello and welcome back to the Week in Markets. This is a chance to review what has been an unusual week for volatility across both equities and bonds. Much of the volatility we've seen even exceeded the height of the inflation shock through 2022. Now it's compounded by a week of very little data in the developed world. The week ended last week with the US jobs data, the non-farm payroll. So we're perhaps going to begin there. I'm joined by Sebastian Mackay, Investment Director here at True Potential. Welcome,
Hello.
Seb. Let's start with that US jobs data because it perhaps helped precipitate some of the moves in equity markets. So what was it in the jobs data in particular that we think worried markets?
I think there was just a general sense that the weakness which has started developing in the labour market in the US is gathering a bit of momentum, particularly the increase in the unemployment rate from 4.1 last month to 4.3 in July. That's kind of suggesting that we're getting to that point where you get that kind of circular weakness in the labour market. And that spooked investors, and it created a situation where combined with quite a weak manufacturing report from the US the day before, it created a situation where investors started to believe that perhaps the Fed had made a mistake by not cutting interest rates at their last meeting.
And I guess because the Federal Reserve had just met on the Wednesday evening for a weaker jobs report than expected to come so soon, markets perhaps overreacted a little bit, didn't they?
Yeah.
So what do we think this means for the monetary policy from the Fed that they didn't cut? What can we expect perhaps from their next meeting in September?
At the meeting last week, Fed Chair Jay Powell was very clear that they probably would cut interest rates at their next meeting in September. The market now has priced the possibility of more than one cut or a 50 basis point or 0.5% cut at the next meeting in September, and is now pricing 100 basis points or a whole percent of cuts before the end of the year. So the market has got quite excited about the prospect of interest rate cuts because the market is getting quite excited about the prospect of quite a sharply weakening US economy. Having been quite resilient for the last few years, investors have suddenly started to worry that actually perhaps we've reached that tipping point where the economy starts to weaken quite rapidly.
Much of what we're describing here as weakening is actually what could perhaps be described as normalisation, which is we're seeing cooling in wage growth. Yeah. You mentioned that jobs are still being created in the US, it's just that there are more people entering the workforce than can find work. But importantly, the economy in the US appears to have slowed quicker than the Fed expected, such that there perhaps is room for them to cut rates more than they had perhaps communicated just 2 weeks ago.
Yeah, I think that's the case, and we would characterise it as normalisation of the economy rather than tipping over into a recession, but the market, having been quite optimistic about the prospects, has suddenly reverted, as the market tends to do. It's reverted from extreme optimism to quite extreme pessimism.
And so that's the backdrop. That's perhaps some of the backdrop in the US in particular. Japan was exceptionally volatile in the equity market this week, Monday morning in particular. So the backdrop here is perhaps a central bank and government policy, which is very different from what we're seeing here. So if we start on the currency, the Ministry of Finance, who help manage currency strength sometimes, for context, what has been going on there with the yen?
So the Ministry of Finance, as you say, who intervene from time to time in the currency market, have been intervening to strengthen the yen. The yen had already, having been very weak throughout the last 18 months or so, the yen had already started to strengthen a little bit, and kind of going with the tide, the Ministry of Finance intervened, so by selling overseas currencies and buying the yen, mainly selling the dollar and buying the yen, to strengthen, so they intervened to strengthen the currency. And then following that, we had the Bank of Japan increase interest rates to 0.25%. It had kind of been expected by market participants, but they did indicate that they would probably increase interest rates again before the end of the year. So that was quite a shift, both from the Ministry of Finance and from the Bank of Japan, to strengthen the currency. And the currency did start to strengthen quite significantly.
Yeah. And that appears to have been the main catalyst for what was a large drawdown in Japanese equities on Monday. So in particular, we came into the office at 7:30 on Monday morning. The Nikkei was down 20%.
Yeah.
So now we don't think suddenly the world revalued Japanese corporates down 20%. So what do we think forced that move in particularly in the futures market, so when most of the cash market wasn't open yet?
I think that long period of a large interest rate differential between Japan and the rest of the world, particularly the US. So, Japanese interest rates have been close to zero for years. US interest rates are at 5.5%. That's a large interest rate difference. And that has led investors to borrow in the yen and invest that money in overseas assets. So there has been a significant build-up of positioning. So that probably exacerbated the move in the underlying currency. And just relating that to the equity market, there's been a number of reasons given for the strength of the Japanese equity markets up until the last couple of weeks. But one of those has definitely been the weakness of the currency, which has helped exporters. So that sharp move in the currency kind of negated that positive tailwind for Japanese equities that's been in place.
So, all of this shock was on Monday, so 20% drawdown in Japanese equities, but as of recording this segment today, down only 6.5%, so have recovered 3/4 of that fall. We did see other equity markets fall as well on Monday in particular, so not just Japan, but the UK and the US, despite having very little correlation with the Japanese economy. So how do we explain that for our clients?
Yeah, I think international markets are very linked nowadays. Many investors are global investors. If they have losses in one part of their portfolio, they might sell assets in another part of their portfolio to make good those losses or to cover those losses. And often what happens is that they sell the most liquid parts of their portfolio, so it might just be equity index futures, for example, that they sell, and so that leads to that kind of spreading of selling across a number of different markets.
Yeah, and we did see, so all the weakness was on Monday, but of course on Monday afternoon we had the services equivalent of the manufacturing survey you mentioned, which showed an uptick in employment intentions, so that helped stabilise markets. And then yesterday we had the weekly jobless claims data from the US again, and that was perhaps not as weak as the markets were fearing. So that again added stability, didn't it? So it does seem there was a huge overreaction to that jobs print on Friday.
Yeah, I think it was that kind of move from optimism to pessimism just was quite extreme. There probably were some technical issues to do with the interlinked nature of global markets nowadays. But also, as you say, we then had some data that suggests that the panic about the softening of the US economy was perhaps overdone. We probably are seeing the economy start to normalise, but there's a difference between that and tipping over into recession.
And so the market's well conditioned for the Federal Reserve to begin cutting rates from September. If they surprise markets, how would we expect, and cut more, how would we expect the Bank of England perhaps to react to that?
I think, the Bank of England has already embarked on its rate cutting cycle. Inflation is now at 2%. Certain bits of inflation, so services inflation, is quite sticky at just under 6% in the UK. But I think the Bank of England has taken comfort from the fact that basically the job has been done in fighting inflation. It's been a hard-fought battle, but they're there. And they've already started to cut interest rates. So I think they would be happy to follow the Fed with further cuts.
I can't think of a better way to end than on UK inflation, because next week, plethora of data, not just inflation in the UK, but in the US. So that's all for today on this review. We hope it's helped provide context on these unusual equity moves. Please do like and subscribe on the YouTube channel, but please join us next week for commentary on all of the economic data that comes, not just on inflation, but UK jobs as well. So that's all for today. Take care and please enjoy your weekend. Thank you.